Joining us now is Wolfe Research's Alex Zukin. Alex, is there going to be an aha moment coming for some investors in Zoom?
David, thanks for having me on. So far be it for me to disagree with Kathy Wood here, but we don't think that revenue is going to accelerate. We think that we're actually forecasting revenue growth to continue to decelerate. We've got, close to a 15% growth rate next year and a 13% growth rate the following year. But something very important is happening at Zoom, and it's that margin story is starting to come out. And we do think that from a margin perspective, free cash flow margins are you're looking at almost $2 billion in our model in free cash flow in 2024. That's a 38% free cash flow margin. It's one of the highest in our space. And we think that's an area that investors are going to have an aha moment with the stock now trading below 20 times free cash flow. It's not going to be a 40-50% grower in our opinion, but can it be a 15 to 20% grower in a bold case scenario longer term? If they start cross-selling other products like phones and events and webinars and rooms, we think that's absolutely possible.
All right. We're again, $2 billion, you said free cash flow 24. So not that far away. And we got a $42 billion market value. We're actually below that now with this bit of a decline, as you said, 20 times. So I guess you're saying buy it here.
Look, we're saying that if people can we don't think that Zoom is going away. It's one of the best brands in the world, in our opinion. We think they've got great products and they've got big markets. Clearly, the pandemic was a massive moment, a massive brand awareness and just connectivity episode for the company. We're saying that if you step back and you're an investor with duration over the next 3 to 5 years, companies that have the best margin profiles in the business, those are the companies that are going to continue to do really well. They're the companies that have outperformed significantly. We did a screen within our names. Companies with 20% or more free cash flow margin since November 9th have almost outperformed the companies that have no margin by 3x. And that's a really powerful statement. And Zoom is participating to some extent we think on the upside, or they can participate when investors return to the segment.
So, Alex, we just talked about Zoom. How about some of the other names that you cover, since you do cover so many software and cloud names that were once high-flying and for which we've seen pretty stark sell-offs in general in recent months?
Yeah, look, we're of the opinion that this sell-off has nothing to do with software fundamentals, that we're in a macro-driven sell-off. And we actually went on record saying we didn't necessarily think that earnings was going to be a catalyst for our space, because the confirmation that fundamentals are solid doesn't really change the current reason for the sell-off. Having said that, where we think the fundamentals are the best is in cybersecurity. We think cybersecurity, names like CrowdStrike, names like KnowBe4, where you can get the fundamentals and you can get the margins. That's an area where we're really pushing investors. And then in enterprise software, similarly, names like Salesforce, names like ZoomInfo, names like Informatica, even Adobe and Workday, names where you can really start to get comfortable with free cash flow multiples, free cash flow margins, and still leading growth rates on an overall sector basis. That's where we're really pushing investors to. I think we got to get through earnings, but I don't necessarily know that that's going to be the catalyst for the space.
Shepard Smith here. Thanks for watching CNBC on YouTube.